Welcome to The Explainer. Today, we're digging into the timeless wisdom of a true classic, Benjamin Graham's The Intelligent Investor.
So what does Graham mean by that? Well, his core message is actually pretty surprising. He says successful investing isn't about outsmarting the market. It's about mastering yourself. The real battle, he argues, isn't fought on Wall Street, but inside our own minds.
Graham says that before you even think about buying a stock, you've got to make a fundamental choice. It's a choice that basically defines your entire approach. So, which one are you? An investor or a speculator? And Graham's definition here is just crystal clear. An investment is based on solid analysis and safety. Everything else, well, that's just speculation. He draws his bright line in the sand, separating a disciplined strategy from what's basically just hopeful gambling.
All right, so let's really break this down. The investor and the speculator, they're living in two totally different worlds. An investor is focused on the business behind the stock. The speculator, they're just watching the ticker symbol, getting all excited when it goes up and panicking when it goes down. The investor actually profits from the market's irrationality. The speculator is the market's irrationality.
And that speculator's world, it's all fueled by emotion and hype. It's a world Graham saw lead to just mass destruction during market bubbles. And you know what? We don't have to look very far to see a perfect example of this.
Just think back to the dot-com bubble in the late 90s. This kind of speculator mindset was absolutely everywhere. People were trading on pure feeling, not facts. And this quote, it says it all. Decisions weren't about a company's health. They were about an emotional reaction to seeing red on a screen.
And you had the media and brokerage firms just pouring fuel on the fire, right? They were selling this idea that trading was some kind of effortless video game. They turned the whole stock market into a national casino. It was easy, it was fast, and hey, it required no thought. This was the siren song of speculation.
And here's the inevitable result, a catastrophic loss of wealth. We're talking over $7 trillion just vanished when that bubble popped. It completely wiped out the accounts of countless speculators who thought the game would just never end.
So you're probably wondering, how does the intelligent investor avoid this kind of disaster? Well, Graham gives us this really powerful mental tool. Think of him as an allegorical business partner named Mr. Market.
Okay, so just imagine this for a second. Let's say you own a piece of a business, and your partner, we'll call him Mr. Market, he's a manic depressive. And every single day, he shows up and offers to either buy your shares or sell you his. His mood and his prices are all over the place.
So on some days, he's just euphoric, right? He's yelling, "Your shares are priceless. I'll buy them from you at any ridiculously high price." His prices are based on nothing but pure excitement, not the actual value of the business. He's totally caught up in the hype and wants you to join him.
But then, on other days, he's completely depressed. He's whispering, "Everything's worthless. The business is doomed. Just sell me your shares for pennies on the dollar." Now he's convinced the world is ending and everything has to be sold off right now for any price he can get.
So here's the absolute crucial point, right? Mr. Market's mood swings are your opportunity, not your master. You are totally free to just ignore him. You never, ever let his mood influence you. You only buy from him when he's deeply pessimistic and offering you a bargain. And you only sell to him when he's wildly optimistic and offering you a crazy high price. You use his folly. You don't participate in it.
Okay, so let's say you're going to buy from a pessimistic Mr. Market. How do you actually know you're getting a real bargain? Well, for that, Graham gives us one more critical tool. It's a strict quantitative principle he called the margin of safety.
And really, in simple terms, this just means you never overpay for an investment. I don't care how exciting it seems. You always build in a buffer between the price you pay and the value you think you're getting.
Let's put it this way. Imagine you do your homework and figure out a business is worth about $1 per share. But, and this is the key, you will only buy it if you can get it for, say, 60 cents. That 40-cent difference, that is your margin of safety. It's your cushion against bad luck, bad timing, or just being plain wrong in your analysis. And this right here, this shows you the devastating cost of ignoring this rule. Let's take a hot .com stock like JDS Uniphase. If you bought it at its peak with zero margin of safety, even if you somehow managed to get a 10% return every single year after that, it would still take you over 43 years just to get your money back. That's the brutal price of overpaying.
So when you start to put all these pieces together, right? The investor's mindset, this idea of Mr. Market, and the margin of safety, What you get is a complete philosophy. It's not just some list of rules. It's more like a personal creed for intelligent investing.
You know, adopting Graham's mindset really means committing to a set of core beliefs. These are the principles that are going to protect you from making emotional mistakes and getting swept up in market manias. It's about being independent, disciplined, and always remembering that your own behavior is the single biggest factor in your success.
And that brings us right back to the question Graham forces every single one of us to ask. Is the risk really in our stocks, or is it in ourselves? The market's going to be volatile, that's a given. Companies will rise and fall. But if you can understand that the biggest risks are actually behavioral, you can shift your focus from trying to predict the unpredictable to controlling the one thing you actually can, yourself. And that, according to Graham, is the real secret to intelligent investing.